Welcome back to the Trading for Beginners course. This is part 5, and today we are diving into one of the most critical foundations of technical analysis, market trends, and the powerful chart patterns that form within them. In this video, you will learn the 3 directions a market can move: uptrend, downtrend, and sideways, and how to recognize each one clearly on a chart, how to draw trend lines the right way, and use them to identify key areas of support and resistance that traders watch, how to spot trade channel patterns, including rising, falling, and sideways channels, which can guide you towards profitable entries and exits, a detailed breakdown of chart patterns, which are usually divided into 2 major categories: continuation patterns. These suggest the current trend is likely to continue. We will cover bull flags and bear flags, bullish and bearish pennants, triangles, ascending, descending, symmetrical, and wedges, rising and falling. Reversal patterns. These patterns often appear at the end of a trend and signal a potential market reversal. You will learn double tops and double bottoms, triple tops and triple bottoms, head and shoulders and inverse head and shoulders, expanding triangles, bullish and bearish, and how descending triangles can act as reversal signals in certain contexts. Finally, we'll go through real chart examples so you can practice spotting these trend patterns and understand how to use them to plan breakout trades with more confidence. By the end of this video, you will know how to read market trends and trend patterns like a pro and be one step closer to building your edge as a trader. If you're finding the course helpful so far, please give this video a thumbs up and subscribe to the channel so you don't miss the upcoming parts in the series. Alright, grab your notes and let's jump straight in. Alright, let's start with something that every trader, beginner or pro, needs to understand from day one. There are only 3 ways a market or a stock can move, and I promise once you get this, chart reading will become way easier. Number 1, uptrend. This is when a stock is climbing and it's setting higher highs and higher lows over time. Think of a staircase going up. Prices move up, pulls back a little, but not too much, and then climbs even higher. This is a strong sign of buyer strength and momentum. We call this a bullish trend, and it's where a lot of traders look to enter long positions, basically betting the price will keep rising. Number 2 is downtrend. This is the opposite of what we just discussed. A series of lower highs and lower lows. Imagine a staircase going down. Price drops, bounces up a bit, but then drops even lower. That's a downtrend. This tells us sellers are in control and many traders will either shock the stock, stay out, or look for a reversal setup. Number 3, sideways or consolidation. This is when the stock is kind of stuck in a range. It's not setting new highs or new lows. It moves up and down within a box, and it can stay like that for hours, days, even weeks. This is often a time of indecision. Buyers and sellers are fighting and nobody is winning yet. We call this consolidation or a congestion zone, and it's super important because breakouts often happen right after. So before doing anything, drawing trend lines, spotting patterns, planning entries, always ask yourself, is the market trending up or trending down or just moving sideways? Because that one question can completely change how you trade. Let's talk about trend lines. This is one of the most simplest yet very powerful tools for analysis. When you're analyzing a chart, a trend line helps you visually connect the key points in the market, and it's used to identify either support or resistance, depending on the direction of the trend. In an uptrend, the trend line is drawn below the price, connecting 2 or more higher lows. This acts as a support line, showing you where buyers are likely to step in again. In a downtrend, the trend line is drawn above price, connecting 2 or more higher lows. This creates a resistance line where sellers are likely to defend and push the price back down. Think of these trend lines as a roadmap of market behavior, telling you who's in control, whether it's buyers or sellers. Now, sometimes price moves sideways or ranges. In that case, we use horizontal trend lines to mark clear support and resistance zones where the price repeatedly bounces. A good rule of thumb is 2 points make a possible trend line, 3 or more points make it valid and strong. So always look for those confirmations before trusting a trend line. Let's look at some charts and try to spot and draw trend lines. Let's break down exactly how to draw trend lines and identify support and resistance using this real chart of Google from stock charts. I'm using Google Stock because it's combining the 3 different trend lines in one chart. So let's start with the uptrend. When drawing an uptrend line, you want to connect at least 2 significant swing lows that define where buyers stepped in to reverse the price. In this chart, I start by marking this cluster of major lows. You can see 3 points here around $82, $84, and $88. These lows create the base of my trend line. From there, I extend the line forward to line it up with the next clear low that keeps the trend intact. In this case, it's this bounce around $140 mark. You can see how the price came down, touched near this line, and bounced higher. Even if the price doesn't hit every low perfectly along the way, the trend line shows us the overall direction and acts like a floor for price action. So remember, when you draw an uptrend line, connect at least 2 solid swing lows. The more price respects that line later on, the more confidence you have that buyers are defending it. It's totally fine if the line doesn't touch every single low perfectly. Trend lines are a guide for the general zone of support, not an exact level. Now let's switch gears and talk about how to draw a proper downtrend line. I beg your pardon. In a downtrend, the goal is to connect lower highs because those show us where sellers stepped in again and again to push prices lower. In this Google chart, I start with the highest peak that kicked off the move down. That's right here, as you can see, around $150.64. Next, I look for the next clear lower high. In this case, as you can see, that's $142.94 mark. The fact that this second high couldn't break above the first shows that sellers are in control. To make the trend line more reliable, we ideally want a third touch or more. Here we can see a clear third lower high around $121.7 and even a fourth one down at about $107. Each time, price pops up but fails to break through the line, confirming sellers are active at lower and lower levels. So when you draw it, anchor your line at the first peak. Then align it to the next lower highs so it cuts across those rejection points. This line acts like a ceiling, showing you where rallies may run out of steam. When the price breaks above this downtrend line, I beg your pardon, it often signals that the downtrend is losing strength and a reversal might be underway. So remember, an uptrend line connects swing lows, a downtrend line connects lower highs. Together, they help you read who's in control, whether it's buyers or sellers. You may need to adjust slightly so your line catches the main rejection wicks, not just the candle bodies. Now let's look at the third market condition. Sideways movement, also called a range-bound market. When the market moves sideways, you will often see price bouncing between a clear ceiling and floor. There's no strong uptrend or downtrend. Buyers and sellers are fighting for control in a tight zone. On this Google chart, we can spot multiple sideways phases. The first clear range is right here. Look for the highest point where price keeps getting rejected. That's your resistance. Here it's around $150. Then find the lowest point where price keeps bouncing back up. That's your support. Here we have multiple touches around $124. So I draw two horizontal lines, one at the resistance around 150 and one at the support zone near $124. Notice that support and resistance aren't always exact points. They're more like zones, so price can dip slightly below or spike slightly above before snapping back into the range. We can always see another sideways phase after the downtrend. Here price finds resistance multiple times in the $104 to $107 area, while the support zone sits around $82 to $88. Again, price keeps bouncing between that floor and ceiling, showing buyers and sellers are balanced. When you draw these levels, always anchor your horizontal lines at the areas with multiple touches. That's what gives them meaning. So to sum up, sideways trends are ranges where price moves between support and resistance levels. Drawing these correctly helps you spot potential breakouts when price finally pushes above resistance or drops below support. Sideways markets often frustrate traders who expect big trends, but can be great for range trading strategies. And that's how you draw trend lines, uptrend lines, and horizontal support and resistance using a real chart example. Practice this on your own charts. Grab your trend line tool, mark your swing highs and lows, and watch how price respects these levels. Remember, always connect at least 2 points, but 3 or more touches make it stronger. Extend your lines into the future. They can stay valid for weeks or months. Combine these lines with candlestick patterns for better signals. So this was an example of how we can draw trend lines and get an indication of how the market is behaving. All right, next, let's look at channel patterns, what they are and how to trade them effectively. Let's break down one of the cleanest and easiest patterns to spot and trade channels. A channel is simply when a stock's price moves up within two parallel trend lines, one acting as support and the other one obviously as resistance. You will often see price bouncing back and forth inside these lines like a ping pong ball. And the cool thing is, channels give us very clear trade setups. There are 3 types of channels we look for. Channel up, this is when the price is trending higher while bouncing between two upward sloping parallel lines. The lower trend line acts as support, the upper one obviously acts as resistance. Traders often look to buy near the support and take profits near resistance, or even ride the breakout above the channel. And then you have channel down, where the price is moving lower but again with a controlled pattern. Two downward sloping lines. The top line is resistance, the bottom is support. Traders might short near the resistance and cover near support, or look for breakdowns when the price loses the bottom of the channel. Sideways channel, or the consolidation range like we discussed in the previous section, is where the price isn't trending up or down. It's stuck between a horizontal support and resistance level. This happens when the market is consolidating or building energy before a big move. Traders usually wait for the breakout or breakdown to take action. Now, how do you trade these effectively? If you are inside the channel, trade the range, buy low, sell high. If price breaks out or breaks down, that's your signal to consider a momentum trade in the direction of the breakout. Just make sure the breakout is real. Always look for volume and candle confirmation. Now let's dive into one of the most exciting parts of this video, called chart patterns. These are visual formations that repeat on charts and give us strong clues about what the market might do next. We'll group them into 2 main categories. Continuation patterns. These patterns usually mean the market is taking a pause, but it still wants to continue in the same direction afterwards. Before we move on, I have prepared this quick continuation patterns table for you. This table summarizes the 10 most common continuation patterns that we will cover in this video, with a simple description for each one. It's a handy cheat sheet you can keep by your side whenever you're analyzing charts. Feel free to pause the video right here and take a screenshot or save it on your computer or phone. This way, whenever you're unsure about a pattern, You can come back to this as a quick reference. Trust me, having this in front of you while you practice spotting these patterns will really help you remember what to look for. All right, let's keep going. Let's look at most common ones. Bull flag. This shows up in an uptrend. Price moves up strongly, then pulls back gently in small downward sloping channel. It looks like a flag on a pole, and when it breaks out upward, that's your signal the uptrend may continue. Bear flag, the opposite of what we just discussed. It appears in a downtrend. Price drops sharply, then drifts slightly upwards or sideways. Once it breaks lower, that's your sign that downtrend could continue. Bullish pennant, similar to the bull flag, but instead of forming a channel, the pullback forms a tight triangle. The breakout upward usually signals the next strong move. A bearish pennant, again, same idea, but in downward trend. A quick drop followed by a triangle-shaped consolidation, then a continuation lower. Ascending triangle, a flat top resistance line with rising lows. This shows buyers are pushing the price higher, and if it breaks above resistance, it's often a bullish continuation signal. Next is a descending triangle, and this is used as continuation. Flat support line with lower highs pressing down, a bearish sign when it breaks down. Next is symmetrical triangle. Both highs and lows converge into a point. It shows indecision, but in a strong trend, it usually breaks in the trend's direction. Next is a falling wedge. Price pulls back in a narrowing downward sloping pattern. It often breaks into upside, continuing on uptrend. Rising wedge, the opposite of what we just discussed. It appears during a pullback in a downtrend and often breaks down. Last but not the least is a rectangle pattern or a consolidation box. Price moves sideways between support and resistance. A breakout in the direction of the trend suggests continuation. Let's dive into the next patterns, which is reversal patterns. These patterns suggest the current trend might be running out of steam and that a reversal could be on the way. So we have summarized all the reversal patterns in the table. Do take a screenshot of this and keep it for your future reference. Now let's look at them one by one. Double top. Price tests the same high twice and fails to break through. A strong bearish signal when it breaks the neckline. Next is a double bottom. Same idea, but reversed. Price bounces off the same low twice. Bullish signal if it breaks above the neckline. Next is a triple top. 3 failed attempts to break a resistance level. A powerful sign of buyer exhaustion. Triple bottom. 3 successful bounces off support. Bullish reversal. Head and shoulders. No, this is not the shampoo. Left shoulder, head, right shoulder. When the neckline breaks, it's a sign of bearish reversal. Inverse head and shoulders. Same structure, flipped upside down, a bullish reversal signal. Bearish expanding triangle. Wide, chaotic swings upward and downward, getting larger over time, usually ends with a breakdown. Bullish expanding triangle. Similar pattern, but forms in a downward trend and often reverses higher. Next is descending triangle as reversal. Unlike in continuation setups, when this forms after a downtrend and breaks upward, it can signal a reversal. Symmetrical expanding triangle, which is the last of the reversal patterns. Both highs and lows are getting wider, can go either way, but when used in the reversal context, it signals a shift is likely. By learning to spot these patterns and combining them with trend directions and support resistance, you will have powerful tools to time your trades better and reduce guesswork. Finally, let's go through some examples so you can practice spotting these trend patterns and understand how to use them to plan breakout trades with more confidence. We will do one example from continuation patterns and one from reversal patterns. All right, our first example will be the ascending triangle. Let's look at this real chart of Agnico Eagle Mines Limited. Its abbreviation is AEM. or the ticker is AEM, to see a great example of an ascending triangle in action. First, notice this horizontal line at around $126. Price has hit this level multiple times, but failed to break above it. That creates our flat resistance level, which forms the top of the triangle, as you can see. Now look at the trend line underneath, which connects the series of higher lows. Each time price pulls back, it doesn't drop as low as before. You can see this clearly with this upward sloping trend line touching the dips around the months of March, April, and May. So do you wonder what's happening here? Let me tell you. This pattern tells us that buyers are stepping in earlier and earlier, pushing price up to the same ceiling each time. Sellers, on the other hand, keep defending that resistance, but the buying pressure keeps building. So when you see this squeeze happening, flat on top, rising underneath, that's the classic ascending triangle, which is a bullish continuation pattern. As a trader, you watch for the moment price finally breaks and closes above that resistance, ideally with strong volume. That's your potential entry signal for a breakout trade. To manage risk, traders usually put their stop loss below the most recent higher low. So if the breakout fails, your downside is limited. And one more tip, the target is often measured by taking the height of the triangle and projecting it upwards from the breakout point. So in this very example of AEM, we would be watching for a clear break above $126 with a good volume, aiming for a move equal to the triangle's height. That is why understanding triangles gives you an edge. They show the story of supply and demand tightening up, giving you a roadmap for high probability breakout trades. Now let's jump to the second example, the double top on BYRN Technologies Inc. Because it shows not only a clear reversal setup, but also how to spot the next key support level where price could head. Finally, we can see the two peaks. The first top in February at around, as you can see, is $34.78. And the second top is right here in July, near $34.3. Price failed twice to break above this resistance, forming the classic double top pattern. Now look at the neckline. This is the horizontal support level connecting the low point between the two peaks, which is around $23.5. The typical double top strategy is if the price breaks below the neckline, it confirms the pattern and signals that sellers might push the trend lower. But here's the important part. You always want to ask, where could price go next? Look left on this chart, and you will see a strong horizontal, a historical support level around $13.6 to $14. This is where price bounced multiple times in the past. So traders might project their target for this double top breakdown by first measuring the distance from the tops, which is around $34.5, to the neckline, that is $23.5. That's about $11. Then subtract that from the neckline, which means 23.5. Take away 11 from that would be 12.5. This lines up nicely with the strong historical support zone around $13 to $14. This adds confluence. Confluence means two signals pointing to the same target. That gives traders more confidence when planning a short trade. Finally, always use a stop loss above the second peak to limit risk if the pattern fails. So in this BYRN example, if price breaks above $23.5 with volume, the next big level to watch would be the $13 to $14 support zone for a possible target or area to take profits. Always check where the next major support or resistance level sits. This helps you plan realistic price targets and manage your trades with more confidence. That wraps up part 5 of our Trading for Beginners course. Now you know how to identify trends, draw powerful trend lines, trade channels, and recognize the most important continuation and reversal patterns that occur in the market. These skills will give you a strong edge as a trader, helping you make more confident and strategic decisions. In the next video, we'll cover another essential technical tool, the moving average. What it is, how to use it, and why it's one of the most widely used indicators in trading. So make sure you subscribe and have notifications turned on so you don't miss it. Thanks for watching, and I'll see you in the next lesson.